Sometimes you can be at a tipping point and not even know it. Things may seem stable, but in reality, you're not on solid ground. That's true in many areas of life, and it's also true when it comes to the financial markets and their potential impact on your retirement goals. It's time to tune out the hype and focus on the facts that matter to you, the income generation.
Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio.
Hello, I'm Jeffrey Small, and it's my pleasure to be hosting the show in Dave's absence today. If you're a regular viewer, odds are you've seen me as a guest on the show several times. As financial advisors and educators, Dave and I share the same commitment to helping retirees like you protect their money from the many risks in today's economy. That often means hidden risks, such as the potential impact of mounting corporate debt. We'll take a close look at the risk on today's show, focusing on the causes and possible consequences for everyday investors like you. Joining me will be Arthur Hogan III. He's the Managing Director, Chief Market Strategist at National Holdings Corporation, along with Eddie Gabor, the co-owner of Key Advisors Group in Lewes, Delaware. First, let's look at why some experts feel corporate debt may be a ticking time bomb for the U.S. economy. There are certain things that nobody likes, but everybody understands we need. We call them necessary evils. Insurance is a great example. Modern society couldn't even function without insurance. We insure our cars, our homes, and our lives to protect ourselves and each other from major financial burdens, even financial tragedy. Debt is in many ways another necessary evil. Economic progress depends on lending and borrowing. And for the stock market, the issuance of debt has become a necessary function of stock market growth. The United States is one of the greatest places in the world to raise capital, and we raise capital in many forms. But the reality is we may be coming to a saturation point for the expansion of debt and the raising of capital, and to a tipping point in the expansion of corporate debt. Granted, we saw a lot of positive economic news in 2018, including GDP growth topping 4% in the second quarter. Corporate profits also hit record highs and are expected to again be strong this year. But behind the headlines, there was and is a hidden truth. U.S. corporations have amassed record levels of debt. While companies should have been paying down debt in the midst of all that economic growth, many were doing just the opposite. In fact, they've been taking on more debt for about the past decade, even as the economy was in slow recovery mode from the Great Recession. Low corporate bond yields since that time have compelled corporations to borrow heavily in the bond market, increasing outstanding corporate debt by over 40% since 2008, when it was already very high to begin with. As a result, U.S. corporate debt now stands at a record of over $9 trillion, and corporate credit as a percentage of gross domestic product is at an all-time high of 45%. That's even worse than the levels reached during the dot-com bubble of 2000 and the subprime mortgage crisis of 2008. Both of which, of course, resulted in devastating stock market crashes. Naturally, that begs the question, could massive corporate debt be a tipping point for the next major market drop or even another financial crisis and Great Recession? No one knows for sure, of course, but many experts are increasingly sounding warning bells, especially when considering the debt problem alongside so many other unstable factors weighing on the financial markets and the global economy. Factors such as the ongoing trade dispute with China, predictions of a major slowdown in economic growth globally, the dangers of a flattening yield curve, economic uncertainties abroad such as Brexit, the potential impact of another government shutdown, and the possible dangers of skyrocketing federal debt, which I'll talk more about later. The point is, the potential of corporate debt to be a tipping point seems greater when you consider that the economy and global financial markets are already on shaky ground. Making matters worse is the fact that many corporations have been using the proceeds of their borrowing to boost their stock prices through share buybacks. In fact, corporate share buybacks have risen to an all-time high in recent years. And this has many economists concerned for several reasons, as they relate to debt buybacks further weaken what many experts believe should be the real measure of strength for a company, not its earnings, but its balance sheet. As bond expert Jeffrey Gundlach of Double Line Capital recently put it, the balance sheets of corporations are balanced on ever-dwindling equities as they buy back shares and increase their leverage ratios. That's not good. I also provide similar insights and discuss corporate buybacks, plus other vital stock market perspectives in my best-selling book, Turning Financial Planning Right Side Up. We'll talk more about that later. But for now, let's welcome my first guest, Arthur Hogan III. He's the Managing Director and Chief Market Strategist at National Holdings Corporation. Art previously served as Director of Research and Chief Market Strategist for B. Riley, incorporated in the Research Division. His financial industry career spans 30 years, during which he has concentrated on the U.S. equity markets, and Art frequently appears on CNBC, Fox Business, and Bloomberg TV. And we're happy to have him here today on the Income Generation. Art, thank you for joining us today.
Thanks so much for having me.
Art, just a few questions today. Well, we've got your expertise. You are an expert on the capital markets, of the highest caliber, actually. And so recently, corporate stock buybacks have been dominating the airwaves. We've heard about them from the Senate. There's socialism versus capitalism debates going on. What is all of this about?
Well, it's interesting. The debate over buybacks and whether they're good or bad has been going on for a decade, and we're hearing a lot more about it because there's legislation being introduced that perhaps there should be some regulation around that. And I think there's three things to think about, and there's some misgivings about what buybacks mean. Now, buybacks in and of themselves aren't necessarily a bad idea. If a company actually has excess profits and doesn't have another productive use for it inside its company with a good return on investment, they should return that capital to its investors. Those investors then take that capital and find better investments to make in other companies. So that's the simple economics. Where it becomes bad is two ways. First and foremost can be timing. Companies can do a very bad job of repurchasing their own shares, buying at peaks in a downtrending market, and actually waste a lot of capital, and that's probably the most common. The other is if there's any malfeasance in the use of this. Perhaps a company decides to buy back shares in front of its earnings, or buy back shares in front of an options expiration for management compensation. Those are things that are the exception, not the norm. But I think in general, buybacks have increased and set a record last year for two main reasons. We had a new tax bill, so there was a lot of cash that was brought back in overseas, and the market capitalization of the overall market was much larger. So when you think about the buybacks in proportion to the market cap, they've been about the same for the last 10 years.
Yeah, that's a really good point, Art. We really appreciate that insight. But why are the Democrats attacking corporate stock buybacks? What's their point of argument at this stage of the economic cycle and the political cycle? Are they balancing politics for bad economics?
Yeah, I think that's the case. It sounds like a very noble case to make. These big bad corporations are making too much money. They should give more to us. And if in fact you skip the economic theory behind a buyback and just say, instead of giving money back to shareholders and having that reinvested in the economy, you gave that to your employees or you invested in your own company. So there is a certain attractiveness to that argument, but it fails to sort of join up with economic theory and financial theory. So that's the difficulty. It sounds great. Hey, these big rich companies should give back a lot of their money, whether it's to employees or investing for the future. But when you think about the best way to appropriate or redistribute capital, it should go over it should leave and exit into the best investment possibilities for the economy. That's where economic growth comes from, and I think that's where wage growth is going to come from.
You know, I agree with you, Art, and I think we'd see a massive amount of companies leaving the country if Washington decided to centralize what corporations should do with either their debt or their cash balance sheets and buying stock back for themselves, because there was a huge trickle-down effect in the expansion of that capital being utilized for stock buybacks. There's a big economic benefit. Okay, so let's shift gears here, Art. Tell me, if I go back to 2000 and 99, we saw corporate stock buybacks peak. In 2007, we saw them peak. In 2018, we also saw them peak. And so will we see another bear market divergence from these corporate stock buybacks, or will the stock buybacks carry the market forward?
Oh, it's interesting. Another myth around buybacks is that they carry the market forward. And if you look at empirical evidence, stock buybacks tend to increase earnings and market performance, between 1% and 2%. And if you look at the stock performance from 2009 to coming into today, we've certainly had, an average of 15 or 16% on the annualized basis of stock returns. So it's not really driving the market. But I will tell you that the coincident measures to what happens at the peak of buybacks and then going into recession probably has a whole lot more to do with what's going on in the overall market capitalization. And I think when you think about all of those peaks that you talked about, there was different things going on in the economy that actually caused that recession. So there's no way to predict if we're going to have recession, and business cycles tend to last in different periods of time. This one happens to have lasted a long time. Along with it has come a larger market capitalization in the overall market, therefore a higher level of dollar-denominated buybacks. I don't think it's a signal of a recession. I think there's a lot more signals of recessions that are out there that we should be looking at.
Well, I think as the economic cycle unwinds, what we'll see happen is corporations will start to tighten their financials a little bit. They won't be deploying as much, issuing as much debt to potentially purchase their own stock back. And so we do expect stock buybacks to start to decline. But there's no doubt that when we see corporate liabilities at this peak and all the other elements of the credit sector peak, we end up seeing some type of a pullback in the markets. And so how are you suggesting investors be agile or defensive at this stage of the cycle?
Well, that's a great question. I think that's probably the most important question. If you lived through this past December and were invested in the market and you saw the kind of volatility that we saw, or if you just look back at 2018 and realized that we had an unusually volatile year with 64 days of 1% moves in the S&P 500 compared to 50 on average and only 8 in the year 2017, you have to adjust three things. You have to think about your risk tolerance and what your plan is. And if your risk tolerance after last year feels like it should be lower, then you want to ratchet down your overall plan. Maybe not be as invested in equities. Pare that back. I think the most defensive thing you can think about if you're concerned about a lot of the geopolitical things that are going on would be to raise cash. And what does that mean? So to have part of your portfolio sitting in cash as an asset class. Cash as an asset class, when you think of what outperformed last year, that was the only thing that outperformed in 2018. So the third thing I think to think about is if you're a long-term investor, there's going to be ups and downs in this market. On average, we have 3-5% pullbacks and something north of 1-10% pullback in any given year. It's best to ride that out and not try to time the market. So the three things I would say, readjust, always look at your portfolio mix, raise cash if you're feeling uncertain right now, draw down some of your equity exposure, but try not to time the market.
Those are all great points, Art. Thank you very much. Stick around. We'll be back with more right after this break.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Headlines such as this, "Why stock buybacks should make investors nervous," have become increasingly common. Stock buybacks occur when a company takes profits, cash reserves, or, as we discussed earlier, borrowed money to purchase its own shares on the public markets. It's a topic I've covered extensively in my best-selling book, Turning Financial Planning Right Side Up. The practice was actually barred in the U.S. until the Reagan administration, but it's been fairly common ever since. And in recent years, corporate America has seen a huge upsurge in buybacks. Between 2004 and 2014, companies spent over $7 trillion on buying back their own shares. And according to the financial research firm TrimTabs, corporations spent a record $1 trillion on buybacks in 2018. Many experts are already predicting that the record will be broken again this year. We've already discussed how debt purchase buybacks have been further weakening corporate America's balance sheet, but that's only part of the problem. A study conducted by the National Employment Law Project and the Roosevelt Institute last year found that the increasing frequency of buybacks has been pulling money away from research and development, employee compensation, and other corporate priorities. According to this study, the consequences could eventually include a host of major negative impacts. The bottom line is that while companies have been working overtime to please their shareholders, many have been doing it largely at the expense of their workers and other important drivers of growth, stability, and competitiveness. While the long-term impacts of this could be severe, the immediate impacts have already been identified in a growing body of research. As we discussed earlier, buybacks and corporate debt have risen steadily ever since the end of the financial crisis. In that same period, the stock market rose by over 20%, fairly steadily until last year's extreme volatility kicked in. Meanwhile, GDP growth struggled to reach 2% for most of that time, creating a huge disparity between market growth and economic fundamentals. Dave has talked frequently on this show about that disparity as partly a result of the Fed's unprecedented use of artificial stimulus, also known as quantitative easing. While the practice of stock buybacks can be seen as yet another artificial driver of this artificial stock market, in other words, a smoke and mirrors tactic that creates the illusion of health and strength over a foundation of debt and instability. In fact, some analysts have said that if it weren't for buybacks, last year's historic market swings probably would have been even worse and possibly led to something more prolonged. Now, as most people know, GDP growth did finally top 4% in the second quarter of 2018, just as President Trump promised it would on the campaign trail. It then hit 3.5% in the third quarter. Trouble is, most economists agree that was most likely a temporary boost triggered by the Trump administration's massive corporate tax cut. Even more troubling, a corporate survey conducted last year by CNBC found that most respondents spent their tax windfalls not on research, equipment upgrades, or raises for employees. Instead, they spent it on, you guessed it, stock buybacks, dividends, and debt. Analysis from Bloomberg, Morgan Stanley, Goldman Sachs, and others estimated that between 40 and 60% of the savings from last year's tax cuts were spent on, that's right, buybacks. Bond expert Jeffrey Gundlach points out that share buybacks have basically turned the stock market into a, quote, high-risk CDO residual that's getting thinner and thinner, riskier and riskier. And I'll talk more about that in just a bit. But for now, let's welcome back Art Hogan, the Managing Director, Chief Market Strategist at National Holdings Corporation. Thanks for sticking around, Art.
Thanks so much for having me again.
Hey, it's great to have you here today, Art. You're such a market capital expert. You've been in the stock market for so long. You understand the cycles and what's happening. We've been asking you some great questions. But right now, with corporate liabilities being at their all-time peak, how much further can we expand that $9 trillion? And what kind of impacts will that have on the market if corporate liability balance sheets are showing $9 trillion of debt when they were around $2.5 trillion back in 2008? I mean, that's quite a bit of the expansion. How concerned should we be about the size of the corporate debt going forward as individual investors?
Well, I think three ways to think about that. First and foremost, when you look at the size of the debt, you always have to compare that to how much equity is in that same framework, right? So when you think about debt to equity ratios, and does this look normal, or is it outside of the normal framework? Is it above average? And right now we're just about at average. We're not at the upper bound of average. So obviously debt levels are going to be higher with the higher equity level. So think about where we were in 2008 with the S&P 500 at or about 700. Now it's about 2,700. Obviously debt to equity ratios are going to balance off. So it's not alarming. What is alarming, though, I think, is that because we had low interest rates for that entire period of time, so virtually for the last 10 years, we had ultra low interest rates, the corporate America preferred way to raise capital was on the debt side versus the equity side. So that gets dangerous when and if we start to see interest rates going up. And it's not the total amount of debt, but it's the ability to service that debt in a rising interest rate environment. So, as Warren Buffett likes to say, when the tide goes out, you can find out who's been swimming naked. We're going to find out who actually, is investment grade rated and who probably should be junk bond rated, and that's probably where we have. But I think that portion of that overall debt is something that's very small. I think that in terms of debt to equity ratios, we're probably just about average, but dependent on how quickly interest rates go up and we start to find out who shouldn't have borrowed as much money in that ultra low interest rate environment, we'll find out pretty quickly.
Well, those are all great points, and I think you nailed it when you talked about servicing that debt. I think the next decade, I think starting in 2021, we've got half the corporate debt starting to mature 2021 through 23 and 24. Half of that is junk. We've got an enormous amount of federalized debt that starts to mature, and the projection is that the debt service federally will be the second largest line item on the budget. And so where do you see interest rates going? I see them going down to zero. They're not going to want to renew that debt at a higher rate because, like you said, they won't be able to service it. So tell us your thoughts.
Yeah, no, that's always been a concern, and we think about this all the time. Interestingly, though, in terms of separating those two issues, in terms of corporate debt and how much of that is sound versus federal debt, which is an entirely different issue, in separating those two, I will tell you, yes, we will get concerned, especially if, in fact, we start to see an economic slowdown. And surely somewhere between today and 2021, we're going to see that. That's when we're going to start to see either restructuring of a lot of the debt we're seeing on the corporate side of things. We're going to see a lot less debt issuance as interest rates go up. And I think that's where that becomes self-regulating. I think the amount of investment grade that lowers to junk is probably going to increase over the next 24 months. On the federal side, that's always been a conundrum. I don't think that we're going to have interest rates going back down to zero, but I don't think we're going to see them skyrocket either. A lot of that has to do with global centralized central bank intervention, and everybody seems to be at pause right now or at neutral. We just heard from the Bank of England. We've certainly heard from the ECB last week, the Bank of Japan, and our Fed all seem to be at the same place. And I think that is coincident with the fact that we're seeing global economic slowdown. That can change pretty quickly, and I think monetary policy and trade policy are in a battle right now, and if trade policy got out of the way, monetary policy would probably get back to normal. But where we stand right now, we should certainly pay close attention to, but I'd be more concerned about corporate debt than I would about our federal debt load.
Yeah, I think I'm right there with you too. I think that the stock market has maybe 6 to 12 more months before we start to see the debt impacted. I think the smart money will start to exit in 2020 as we see what the Fed does and what's going to happen with the budget going forward. But so I'm in complete agreement with you on that kind of thing. So I think there's a few more months here we can maybe have a little more bullishness and capture some few more market gains. So that's where we are today. So Art, it's great having you here. Thank you for taking the time. Please stick around. We'll be back with more right after this break.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Though a necessary evil for the economy, debt always had an element of risk, and one could argue that the relationship between debt and risk is directly proportional, meaning more debt equals more risk, period. That's exactly why so many experts today are becoming increasingly concerned about rising corporate debt, and why we're discussing it on today's show. I mentioned earlier that bond expert Jeffrey Gundlach has called the equities market a, quote, high-risk CDO residual that's getting riskier and riskier. CDO refers to collateralized debt obligations, debt securities that are sometimes bundled into CDOs. Then in a process called tranching, they're basically sliced up into pieces with various levels of credit risk and then sold to debt investors. If all that sounds familiar, You may recall that unregulated sale of CDOs along with mortgage-backed securities and other derivatives in the early and mid-2000s played a key role in creating the last financial crisis. These derivatives became extremely popular with banks, hedge funds, and investors because they were profitable and appeared almost risk-free. Demand increased to the point where banks and mortgage brokers offered home loans to just about anyone. And banks offered subprime mortgages because they made so much money from the derivatives rather than the loans themselves. At the end of the day, though, all this profitability in the absence of risk, well, it was an illusion. It wasn't real because it was built on a growing mountain of homeowner debt. And once the Fed raised rates on subprime borrowers, the mortgage default started, the illusion vanished, and reality hit home with a vengeance. As we've seen on today's show, the growth and strength of corporate America and the stock market since the financial crisis are all illusions to a certain extent. Behind the curtain are record levels of corporate debt and stock buybacks at an all-time high. So, does all of this mean that we're definitely at another tipping point, that the day of reckoning is inevitable? Well, as I stated earlier, no one can predict the future, and there's truth in the old saying that anything is possible. But if you're within 10 years of retirement and looking to decrease your financial risk, as I believe you should be, you might want to consider the issue of corporate debt very carefully. As you're doing so, keep in mind the historic levels of volatility the stock market experienced in 2018, which could very well be a sign that the illusion is indeed starting to fade. For the first time in history, in 2018, the S&P 500 ended the year with a loss after being positive for the first 3 quarters. In addition, the stock market endured its worst December since the Great Depression and its worst year since the height of the financial crisis in 2008. So far this year, things have stabilized a bit, although all the major market indexes are still down from their peaks. Wall Street has been making every effort to focus on good news, such as early fourth quarter earnings reports and the Fed's new, more dovish tone on raising interest rates. Meanwhile, though, big investors are also striving to ignore bad and ominous news, such as new concerns about the trade war, the economic impact of the longest government shutdown in history. You can add that to the list. The increasing warning bells being sounded about corporate debt, not to mention our still skyrocketing national debt and the federal deficit, which is expected to hit $1 trillion this year. If the warning bells are right, what can you do to prepare and minimize your own risk? I'll talk more about that in just a bit. But for now, let's welcome back Art Hogan, the Managing Director, Chief Market Strategist at National Holdings Corporation. Art, thank you for sticking around.
You bet. Thanks so much for having me.
You know, Art, I'm a big fan of math as a tool for navigation to determine what you should have with your money going forward. In other words, efficiency testing and stress testing. What happens to money if we have risk, cost, withdrawal, growth as a combination. But going forward, if you're 60 years old, for our viewers here on the income generation, if you're 60 years old and you're getting ready to retire, you've retired, and you've got a portfolio of $1 million or $500,000, you know, how much risk should you have today if you're trying to create income from that portfolio? Tell us what your thoughts are.
Yeah, that's a great question. We'd like to think about this in the rule of 4, right? So you want to have a 4% drawdown and be earning a 4% interest at the same time. So it leaves your, it in a sense leaves that portfolio unchanged. So, you know, what does that mean? You need to find a way to have a 4% return with the least amount of risk. And you want to not draw down more than 4% on a basis. We're living longer, so changing the way you decide about your long-term investment horizons has to be adjusted for that. So the fact that you're going to need to have this, if you're 60, you need to have this last for 20 years versus 20 years ago, you needed to have that last for 8 years. I think what you're looking at now is thinking about that asset allocation model that has the least amount of risk that gets you as close to a 4% annualized return. That generally means you either want to be in a fixed income product or something that is a high yield dividend product with very low expenses.
Well, Art, you must have been watching this show a lot because that's exactly what we discuss the majority of the time is fixed income and how to generate that yield and not be codependent on performance, but yet be dependent on income so you can subsidize your lifestyle when you retire. That's a really critical area. We like to focus in on that. What are some of the things that you would recommend for advisors or for clients to purchase for customers or purchase for themselves so they could generate that type of yield or income? Specifically, be specific. I mean, are there bonds out there? Are there preferreds? Are there good common stocks that are good dividend paying that are stable for fixed income like investments? What do you like?
Yeah, I think that the three ways to think about that, I think those are great questions. First and foremost, the biggest thing that is going to separate you from your money and that actual 4% return you need in retirement with a 4% drawdown is how much you pay in fees. So you really want to think about making sure whatever investment vehicle that is, it's got a low cost to get that type of yield. And I think that looking at that, there are dozens of things in the ETF world that are either mirroring the kind of yield that you get in a bond fund or mirroring what you would get in a high dividend equity fund. I think looking at things that way. The second thing that's imperative, and I think you brought that up, was dividend paying stable stocks. And unfortunately, dividend paying stable stocks have gotten very attractive in this low interest rate environment over the last 3 years. So that group can actually become very expensive. A lot of investors think I'm getting defensive and I'm going to buy things like consumer staples and telecoms, real estate investment trust, and utilities. Those are some of the dividend darlings that have performed very well, so much so that perhaps those multiples are a little high. So always look at what you're paying in terms of cost, because a lot of that yield can disappear if the multiple on those groups come down even 1 or 2 turns. So I think the third thing you want to think about is term. So right now in the current interest rate environment, and if you're looking in the fixed income world, I would still keep your term shorter. Meaning by I don't think you want to go out. I think you want to stay inside the 3 to 5 year time horizon versus going out 7 to 10 years. I think that's because the stability of interest rates right now are in question. I think that thinking about those 3 things, though, the most important of all those things is make sure your costs are as low as possible to get that 4% return.
Absolutely. So one question, Art, I've got for you. So we're really on the same page on a lot of this stuff. How do you feel about preferreds? Preferreds are bond-like instruments. They're not really traditional common stocks, but they are non-volatile components. So tell me how you feel about preferreds.
Yeah, we're very big fans. We do a lot of business in preferreds. Or, people like to refer to them as baby bonds. They have stability. They oftentimes pay, in the sort of 5.5 to 7.5% return. They tend to be stable, but you need to know how stable the company is behind that. So make sure you know what you're buying when you get a preferred or a baby bond. If you trust the company, if you have the sound financial backdrop of that company in mind, if you like the sector that it's in, then issuance of baby bonds or preferreds is another way to capture that yield, and it's a very cost-efficient way to do that. You're in at one point in time, and then you're collecting that yield until it matures.
Absolutely, Art. I could not agree with you more. I want to thank you for joining us today. The Income Generation continues right after this break.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
One of the biggest self-help books of all time was called All You Can Do Is All You Can Do. The title serves as a good way to think about your financial choices, especially in uncertain times and periods of high risk, like we're in now. It's frustrating, but there isn't much that we as ordinary citizens can do about most of the major issues fueling all this uncertainty and risk. We can't force a major corporation to rein in its debt or to invest in its workers instead of buying back its own stock. And while we can elect lawmakers that we think are fiscally responsible, we can't ultimately force them to balance the federal budget. Again, all you can do is all you can do. And what that means is making sure your own house is in order. It means making sure you're not ignoring potential risks and mistaking illusions for reality, even if Wall Street and Washington are. With that in mind, here are 3 quick tips for protecting yourself from the potential consequences of mounting corporate debt, whether that means another all-out financial crisis or just the next major sustained stock market drop. Number 1, reduce your own debt. Though we haven't mentioned it, mounting consumer debt is another growing economic concern. Fortunately, most baby boomers have focused on paying down debt and rebuilding their savings since the financial crisis. If that includes you, stay focused. Number 2, reduce your stock market risk. If you're a regular viewer, you know that process starts by making a strategic shift from focusing on portfolio growth to retirement income. Properly managed income-based strategies are designed to lower your risk of suffering a major financial loss in a volatile market and to provide reliable income regardless of market conditions. And number 3, find the right financial advisor. I believe that means an advisor who specializes in working with retirees and near retirees and with income-based strategies geared toward risk reduction. Now let's welcome my next guest, Eddie Gabor. Eddie is the co-owner of Key Advisors Group in Lewis, Delaware. He began his career in financial planning in 1998, focusing on retirement and estate planning strategies and specializing in money management. Eddie, thanks for joining us today. It's great to see you.
Thank you for having me. I appreciate this.
You know, every time I turn on Fox News, you know who I see?
Who's that?
I see you sitting with the panel. You're a new star on there.
Thank you. It's been an honor being asked to be on these shows, and it's a humbling experience, but I'm truly having a lot of fun doing it, and hopefully giving a lot of investors some good advice that they can take in their own financial plans.
Well, I find your comments always very helpful. But today, we're going to talk about some things that are affecting the stock market and some concerns that we have. The theme of our show today was corporate stock buybacks. And what we've noticed, Eddie, historically is that there's usually some type of a bear market divergence when corporate stock buybacks peak. And I'll refer back to 1999 when they peaked, before the dot-com collapse, and 2007 when they peaked. And so now we had a peak last year of $1 trillion. And prior to last year, corporations were buying back an average of $50 billion a month of their own stock starting in 2010. And the majority of those purchases were leveraged. In other words, they bought that stock with somebody else's money, not money off their balance sheets. And so tell me, do you think there's going to be a bear market divergence? Because I know you're a bull, and that's okay, but I want to hear about what your concerns are, because there are correlations to corporate stock buyback peaks. So tell me your thoughts.
Look, there's without a doubt, I can't deny the fact that there's correlations there. And yes, I've been very bullish over the last several years, as you well know. But look, we do know all good things eventually end. So this bull market's not going to run forever. And so I agree with you to a certain extent in regards to the corporate buybacks. So much demand coming from corporations that if you extracted that $1 trillion of buybacks, stock prices wouldn't be as high as they are today. So naturally, when you start to see a decline there, that's going to be a red flag for stock investors to maybe possibly reduce the risk that they're taking in their portfolio. What concerns me the most is what you talked about, leverage. I think that leverage and corporate debt side of things is a bigger concern to me, frankly, than the buybacks, because we know that when people get over leverage, it's just a ticking time bomb. So as long as corporate buybacks stay strong, which they still are, I'm not disputing the fact that they may have peaked last year. I don't see a crash here short term, but over the next few years, you have to question how long this bull market can run.
Well, there's still some legs in the bull market, isn't there?
There is. The fundamentals for this year still look good. After the decline we had in the fourth quarter, I felt really good coming into 2019 that we would see double-digit growth in the S&P. Obviously, it's on track for that, but it's still really, really early, so we'll have to wait and see. I think volatility is going to be here to stay, though. So these double-digit drops we're seeing throughout the year in the market are here to stay, but I think 19 can be a very profitable year for the stock market.
Well, I agree with you, Eddie. We are still at a point, though, in the markets where we're still 10% below the peak. We dropped 19.8% from the peaks last quarter, and so right now we're playing the catch-up game. So for now, the stock market money might be dead money unless it can come back to the peak and approach that ceiling. Now, we're going to stick around and be right back with Eddie Gabor after our break. Welcome back. We're talking with Eddie Gabor, the co-owner of Key Advisors Group in Lewis, Delaware. Eddie, thanks for sticking around.
Thank you.
Let's talk about your new book, Eddie. You're a brand new author. You've got a book coming out called The Common Sense Bull. Is that a loaded question? Joking around. The Keys to the Good Life Before and During Retirement is the rest of the title. In your new book, Eddie, do you identify the frame of mind and strategies required to not only survive, but thrive in today's markets? Could you tell us here a little bit about that at the Income Generation?
Yes, I'd love to. So the book that we've just come out with is going to share a lot of the core principles that we've used in our practice for many years to try to help guide people throughout the rest of their retirement, and talks about some of the fundamental approaches that we've used. One of the biggest keys in this book is talking about risk management. We constantly talk about risk management here at our firm with our clients. Look, it's well known that I've been a bull for a long time, and I'm still a bull, but I have never put my clients in a position or think it's prudent for them to put a very large percentage of their investable assets in the stock market when they're retired. And so many people are walking around with a portfolio of 60% stocks, 40% bonds, and think that they're protected. And then when the market crashes, they have a correlation usually of 70 to 80% of the market, which is much higher than what they think. So we talk about some of the things to look for in a portfolio to clearly understand the risk you're taking. We talk about things like on the stock side, being a little bit more defensive and investing in companies that pay dividends and, more importantly, have a history of raising dividends. Traditionally, those types of companies have had less volatility than your technology companies and your high beta stocks. The other thing we talk about is really being disciplined and not making emotional decisions with your investing. This fourth quarter was a perfect example. I'm sure anyone that panicked and sold everything out of the market is probably kicking themselves right now. But had they had a good risk management plan in place and were disciplined and have a coach to be able to bounce ideas off of, they probably would have just stayed the course, and now they're looking just fine.
Sure.
So I'm hoping that this book will educate them in many ways.
Sure. That's awesome, Eddie. I can't wait to get a copy and read it. What role, though, do you think soaring corporate debt and stock buybacks will play in the next big shake-up in the financial markets? What will the impact be?
I think the corporate debt side is the thing that I have as the biggest concern from the stock market, okay? Look, leverage is really good when the economy is growing like it is and when we're not in a recession and when interest rates are low. But when interest rates rise and the economy slows down, that corporate debt is going to be a problem. If I had to pick one area that will cause the next major drop in the market sometime in the future, it's corporate debt. Because as you know, sometimes people ignore the discipline of not over leveraging when things are really good, but they don't stress test their balance sheet. So when rates go up, these companies are going to have a very hard time.
Eddie, I got to cut you off. I completely agree with you. I couldn't agree with you more. I think corporate debt is the next time bomb. I want to thank you for joining us today, and I can't wait to read your book. I'd like to thank all my guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. Of course, I'd also like to thank David Scranton for giving me this opportunity to host the show today. I've really enjoyed it, and I hope you have too. Most importantly, I hope you've learned a bit about how imperative it is to be aware when you might be on a potential tipping point. There are all kinds of tipping points in life. And as we've seen on today's show, the record levels of corporate debt bubbling beneath the surface of the economy and financial markets could be another. We've seen how the illusion of profit built on debt can have devastating consequences, most recently with the financial crisis. We know that stock buybacks have increased steadily in recent years and hit an all-time record in 2018. We've seen how debt purchased buybacks have further weakened the true measure of strength for many companies, which is not the earnings, but their balance sheets. And we've seen how all of this has helped contribute to a stock market still wildly out of whack with economic fundamentals, even dangerously out of whack, according to a growing number of experts. The danger may have become much more clear than last year when the stock market experienced record high levels of volatility and finished the year at a loss. Was it a warning sign that the illusion is starting to fade and reality is starting to take hold? Only time will tell, of course. But if you're retired or close to retirement, is the risk really worth it? Remember, you might not be able to do anything about corporate debt, the federal deficit, or any of the dozens of other potential tipping points out there today. But what you can do is take steps to reduce your own risk of getting caught in the next major market downdraft, ideally by working with a qualified financial advisor who specializes in income-based financial strategies. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it, on the Income Generation. Thanks, and we'll see you next week.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.